Hello, my name is Tiffany C. Wright, and today I'm here to talk to you about financing your business, to go over some of the options that are available to you to fund the startup or growth of your business or to fund an acquisition. This particular presentation is targeted at small businesses, those with $500,000 to $5 million or less in annual revenues. For those with significantly larger businesses, check out the medium-sized business presentation that I previously posted. If you want to know more about me and my background, I cover that briefly at the end. The first thing when it comes to financing your business is to take what is often perceived as an innovative approach by business owners. You must view your business as a separate, viable entity from yourself. Just like a stock or bond or real estate or any other asset out there, you need to view your business as a marketable asset. You need to view your business as a source of long-term wealth and as a creator of employment and jobs. You also need to look at your company as a source of investment income for yourself and the other founders or for others who believe in the business, otherwise known as investors. In this presentation, I'm just discussing options. Obviously, bank debt is an alternative, and everyone's aware of that. There are also alternative debt options that exist. Asset-based lenders are a big source. These include receivable financing entities such as factoring companies and accounts receivable credit line providers. It includes purchase order financing, which is actually guarantees. This category also includes equipment loan providers, which are typically industry-focused manufacturers, distributors, or third-party equipment financing entities. You can take out a loan against a property you or your business owns. You can utilize supplier or vendor financing. There's a tried and true use of business credit cards and charge cards. The key here is to remove any personal guarantees on those credit cards or charge cards over time. If your company is really small and only needs $25,000 or less, there are micro-lenders such as Axion available, or you can utilize peer-to-peer lending sites like Prosper.com. When a company is small and largely unproven, the best sources of funding are from those who believe in you personally and think your business concept is viable. Therefore, for small businesses and startups, the first equity source to tap is your own personal investment. The next is investment from family and friends. After that, sources include angel investors, who are individuals or companies who invest in unproven ventures, hence the moniker angels. Then we move on to the next set, which are joint ventures. You can formally partner with another proven entity to go after a new market. That's just one example of a joint venture. That entity may provide much of the initial funding. Another option is strategic investors, such as a mid-sized company operating in your realm. And yet another option is direct public offerings, or DPOs, through which you can tap your customers and others for equity. The maximum amount that can be raised through a DPO is $1 million. What do investors want? And this is very important to keep in mind. Investors want a strong return. If it's a bank or similar low-risk entity, then they want a lower return like 8%. But if it's a higher risk entity, or if the company has an elevated risk profile, or they are investing in equity such as a private equity firm does, then they want a greater return like 40% or sometimes even higher. They need a clear payoff date and an exit strategy, typically within 3 to 7 years. But they need to know when they're going to get their money out. They are not interested in hanging out for 10, 15, or 20 years with no idea of when they'll get their money back. They want to know in advance when they can expect a payout, and they'd prefer to have an option A and an option B in case plan A doesn't work out. A strong management team is vital. A strong management team can take a so-so company and make it great, but a mediocre management team can take a good company and drive it into the ground. Investors also want a base valuation of the company. You should know what your company is worth. The investors may value the company higher or lower, but if you have no idea what your company is worth, then you have no idea whether or not you're getting a good or bad deal on the money the investors are putting in. And you need to have a plan to accomplish your goals. If you say you can double the size of your company in 3 or 5 years, or reach a certain revenue target during that time frame, and the investor asks, well, how do you plan to accomplish your goals? And you just say, that's not good. You lose, you lose all credibility. Blended debt or equity is also known as hybrid. This is available for small companies, but the options are greater once you reach $10 million in revenue. For small companies, these are available through your personal or business brokerage account. And other sources include mezzanine or acquisition finance companies. And what this is typically debt at a higher interest rate than you would get at a bank, with warrants or options attached to them. I'll go into what this is and what warrants and options are in another presentation later, but for now, just know that these exist. Now, the main thing when you're thinking about sources of financing is to be aware of how much money you need. That's why you'll see sources and uses of fund. How much do you need and for what? Because you may not actually have to go out to an official financing entity to find the funding. The funding may be available right there with your partners or your customers or whatever, depending on what you're trying to accomplish. If you're trying to enter a new market, you may be able to co-brand or co-market with someone else. You may be able to pool funds through a cooperative. Or your customers may help you through customer deposits and prepays. Or you may opt to hire management, engineers, or other personnel and service providers using equity as a form of partial or full payment. There are economic development grants that exist to help companies grow, and the amount of these depend on the impact that the company will make in a city or region in which the company is located. There's licensing. You can use a self-directed IRA to fund a company's growth or startup, and there's the option to swap or barter. And again, I will go into these in more detail in later presentations. I just want to make you aware of the alternatives that are out there, or at least some of them. Now, if you're looking at acquiring a company, remember the financing comes from or is based on the entity that you are acquiring. So if you're buying that company as an individual, or if that company is significantly larger than your current company, that's fine, because whoever is providing the financing is not primarily looking at your particular assets to pay the money back. In general, they want to make sure that you have skin in the game, so they will take a look at your assets, but they're mainly focused on the cash flow generated by the company you're acquiring. That cash flow will be used to pay down the debt or to generate the expected return on equity. If the company you're acquiring is too small to generate much cash, then you or your company will be looked at to pay back the loan or generate the return. And of course, you'd know this in advance. So the options that exist for acquisition financing of small companies include owner financing, supplier or vendor financing, mezzanine or bridge financing, bank debt, receivables financing, or prepaid sales. Again, I'll talk more about these later. So to get started, here's my little pitch. I wrote a book called Solving the Capital Equation, Financing Solutions for Small Businesses, and it's available on Amazon. It actually does read very easily. It has really easy to follow case studies and examples, suggestions, questions, and guidance, and is written the same way I'm speaking now. We also have an ebook, Help! I Need Money for My Business Now, available online at www.smallbusinessfinancingresource.com. You can download that one immediately. The other book is available on Amazon. Again, I said I'd give some background on myself. In the last 5 or 6 years, I've helped companies raise about $31 million in financing. I have an MBA in Finance and Entrepreneurial Management from the Wharton School of Business at the University of Pennsylvania. I've bought a company and am looking at buying more. I have started a couple of companies. I've served as the interim CEO, COO, and CFO of a number of companies, and I've served as an advisor to a number of CEOs, in addition to sitting on the advisory board of a few small companies. So that's just a little bit of background on me. If you want to see more financing options, check out my blog at blog.smallbusinessgrowthcapital.com. I'm Tiffany C. Wright. There's the information. Thank you very much.